I guess, you know, somehow our transparency initiatives have been used by somebody, and so we thank you for that. Oh, good. Dr. Jarecki, it's so good to see you back. You last testified here last summer. I remember some very helpful dialogue and exchange at that point in time. Dr. Jarecki, who's chairman of Gresham Investment Management, but has been a real leader in a number of fields, not only the fields that we're talking about here, but the fields of psychiatric treatment and leading expert there, but more relevant. Is it right that you were the founder, or maybe along with others, with the Makata Group years ago, and was really the largest gold and silver trading company? And so his association with these issues goes back decades.
I was the founder of CABA, which was formed in 1671.
Okay. Well, no, I didn't mean to. All right. So I thank you for that clarification. That's very good. I can see this is going to be a lively afternoon. Good to see you also, John Lotho. I did it wrong the last time, so you're going to help us. Lothian. John Lothian, who's Chief Executive Officer of John J. Lothian and Company. But this online education and media company publishes newsletters, blogs, now wikis and so forth, and follows these markets closely. And then our last panelist, Bill Murphy, who is with the Gold Antitrust Action Committee, and he chairs the GATA Summit in South Africa, and he's been involved in many of these issues. So we thank all of our panelists, and we're going to go, I guess, from right to left. And if you have written statements, they'll be included and they'll be on our website. But if you could try to help us summarize in 4 or 5 minutes, that would be terrific.
Absolutely. Chairman Gensler, members of the Commission, my name is Tom Callahan. I'm the CEO of NYSC Liffe US, the U.S. Futures Exchange of NYSE Euronext, and it's a great honor to appear before you today. Launched in September 2008, NYSC Liffe US is registered with the CFTC as a designated contract market. It currently clears its contracts through the Options Clearing Court. The National Futures Association conducts day-to-day market surveillance of our exchange. Our parent company is NYSE Euronext, a leading global operator of financial markets and one of the world's most highly regulated global financial firms. NYSC Liffe US provides fully electronic liquid market for physically deliverable gold and silver futures, options on gold and silver futures, and mini-size gold and silver futures as well. The lineage of our exchange traces back to what was once known as CBOT Metals, which was divested by CME Group in March 2008 so as to preserve competition in the U.S. metals market in the face of the pending CME merger with NYMEX COMEX. NYSE Euronext is working hard to deliver on this objective to promote fair and effective competition. In the U.S., we directly compete with CME's COMEX exchange. Currently, our young exchange is trading roughly 5% of the total U.S. precious metals futures market by volume. In our attempts to establish a world-class U.S. futures exchange, we are investing heavily in our platform and recently took on 6 important market participants as partners in this endeavor. Today, I'd like to address certain areas of focus for the Commission as we review regulation of the metals futures markets. We share the Commission's objective to ensure that the U.S. precious metals markets remain fair and competitive, while retaining the highest degree of integrity for the protection of investors. In its capacity as a CFTC-registered DCM NSRO, NYSE Liffe US currently places position limits on its metals futures products. Our current levels of position limits are extremely conservative and we believe protect the market from manipulation and excessive speculation. These limits are set by the exchange. NYSE Liffe US has maintained these conservative limits because it retains the flexibility to adjust them as market conditions may demand. One of the clear lessons from the financial crisis is that the exchange-traded and centrally cleared market model performed exceptionally well as the over-the-counter markets faltered. Accordingly, as new regulations such as position limits are contemplated, the CFTC should be mindful that they are implemented in a way that does not force business away from regulated exchanges and into the over-the-counter markets or to foreign jurisdictions. In addition, if federal position limits are determined to be necessary for the metals markets, the CFTC should design the regime so not to solidify competitive advantages for the currently dominant exchanges or to hinder the migration of OTC business to a centrally cleared exchange-traded environment. Some have suggested that the CFTC take into consideration the relative size of a market when administering certain position limits. For startup exchanges like NYSC Liffe US, it would be difficult, if not impossible, to gain market share against an existing exchange if position limits were administered in a manner that capped growth or growth potential. Should federal position limits be needed, either limited exemptions for new competitors or minimum position limits should be in place to ensure that competition is not hindered by cross-market position limit regimes that would lock in market share with an incumbent exchange. Finally, while I speak today as the head of our U.S. futures trading business, NYSE Euronext also has a significant exchange-traded products business that will be impacted by position limit policies. An exchange-traded product is an investment vehicle traded on a regulated security exchange which typically owns assets such as stocks or bonds, though more recently are diversifying into other assets like commodities. They provide retail investors with a cost-effective way to invest in and hedge commodity exposures through regulated, transparent marketplaces. Recent months have seen certain energy ETFs for commodities either close up or move overseas in advance of anticipated position limits. While rational position limits, as we impose on our exchange today, are needed to protect against manipulation and excessive concentration, the Commission should be mindful that federally set position limits could have a serious negative impact on other markets that use futures contracts to either discover prices or manage risks. As a new entrant into these markets, NYSE Liffe US is committed to the derivatives marketplace and eager to compete for the benefit of investors and consumers. Thank you for allowing me to testify.
Thank you, Mr. Callahan. Mr. Norrish.
Good morning, ladies and gentlemen. My name's Kevin Norrish. I'm a Managing Director in the Commodities Research Team at Barclays Capital. I think the CFTC is to be commended for holding this debate, and I'm very pleased to be here to make a contribution to it. My background is that I've spent 22 years analysing and researching industrial metals markets, and I've seen a number of big changes in the markets in that time. Two of the most important, I think, are the real growth in the use of futures markets by producers and consumers to manage their very real day-to-day price risks. The other evolution that I've seen, which I think is also very important, particularly in the last 10 years, is the increasing use of the commodities futures markets by financial market participants who are seeking commodity risk in order to protect against their own inflation risks or to diversify their portfolios. Now, I think those two developments are very mutually beneficial. What I want to do over the next few minutes or so is to really focus on three key issues which I think are really very important to this debate. I think the first point that I would make is that I think financial involvement in the commodities futures markets is a very good thing, and we need more of it. And the reason for that, I think, is that we face, over the next 10 to 15 years, a massive increase in demand for commodities, all sorts of different kinds of commodities. And that's being driven by what's going on in the industrializing Asian nations, the rapid growth in industrialization, living standards and urbanization, which is driving huge additional demand for commodities, and that's going to continue for a long time. We've got one of my slides up on the screen here at the moment, and that shows you that the International Energy Agency believes that $25 trillion needs to be spent over the next 20 years, just in energy supply infrastructure, not in other commodities, but just in energy supply infrastructure. Now, how is that demand going to be met? Well, this demand is coming at a time when it's very clear there are a number of supply constraints in many important commodities markets. That's partly due to a lack of deposits, a lack of exploration and development activity, supply bottlenecks, and lack of qualified labor. So it's really very important, I think, that we have large liquid financial markets to assist producers in being able to make these very big investments and to be able to protect the risks that they have. I remember very well the 1990s when there was very little financial market involvement in the commodities markets. And back then, markets were depressed. And what we saw, the behavior from producers then was that producers would cut costs. There was very little liquidity for them to manage their risks. They would cut costs and they cut back on exploration and development. That's part of the reason why we have high metals prices today. So I think it's very important that we have the financial market participation. I think there are two key things. First of all, there's a huge mismatch between producers' needs to manage their risks, very large, capital-intensive projects, often over very long time periods that they need to manage, and consumers who tend to be a lot smaller and have much shorter time periods to manage their risk over. So the financial market participation helps to bridge that gap. I think I would say the other thing is that we need large financial institutions involved in these markets as well. And that's because commodity market risk, by its very nature, tends to be lumpy and unpredictable. You know, we have large capital-intensive projects to risk manage, large amounts of inventory to finance, and these things can only really be done by flexible, large financial institutions that are able to lay off that risk in different ways, in the futures markets, in the over-the-counter markets, and in the physical markets. So I think we need more of this kind of activity. This kind of activity needs to be encouraged to grow. We don't need less of it. So that's my first point. My second point is that when it comes to the role of US futures markets, commodity futures markets, and particularly the metals markets, that crucial role of price discovery and liquidity is very easily exportable. And I'll tell you why. It's because we've seen a huge shift in the nature of commodity market demand over the last few years. Let's go back to 2002. Back then, the US consumed as much copper as China did. Today, China consumes 3 times as much copper as the US does, and that number is just going to continue getting bigger. So I would say that given those sorts of changes, the US commodity futures markets, and particularly the metals markets, are punching above their weight. They are continuing to play a very important role in global price discovery and in the addition of liquidity to markets, enabling people to use them to manage their risks. I think the danger is that if unnecessary position limits are imposed in US markets, then it will drive that liquidity to other venues, and you will see a reduction in the relevance and importance of US markets. And my final point is on the role of index investors specifically. There have been a lot of wild things said about the impact of index investors on prices. And I think I would like to just correct the record a little bit. When we look at the role of index investors, my belief is that they act as price stabilizers. And that's because index investors are seeking commodity price exposure in order to diversify their portfolios. So they tend to buy when prices are low and sell when prices are high. And you can see that in my chart here in the oil market. So just to finish, I would say that US markets need to continue to be a very important part of these global financial markets. We need to encourage speculation.
If I could ask you to...
Yeah, I'm just making my final comments. Sorry, I've gone a little bit over my time. But I think we need to encourage financial market involvement. We need to consider flexible, I think, accountability limits are the way to go, because commodity markets do need the flexibility. It's that flexibility which best serves all market participants, the producers, the consumers, and the financial institutions.
Thank you.
Thanks very much.
Dr. Jarecki.
Good morning. My name is Henry Jarecki. I'm chairman of Gresham Investment Management that provides advice and execution services to investors, large and small, who wish to diversify stock and bond portfolios by... Am I on the air? No, I'm lit up. I apologize. I hope you don't count this time against me. My name is Henry Jarecki.
No, start it over, Doug.
Gresham Investment that provides advice and execution services to investors, large and small, who want to diversify their stock and bond portfolios by adding a diversified pool of commodities to them. And I thank the Commission for inviting me to appear before it again, and I presume you have all brushed up on your Latin in preparation for my testimony. It is worth emphasizing, first off, that the futures markets have, over the past 2 years, proven themselves to be immune from the troubles and especially the risks and balance sheet fiddles that afflicted the over-leveraged stock, bond, and real estate markets. I think this is because they deal with leverage in a rational way. Namely, day in and day out, they mark all customers, big or little, commercial or speculator, to market, and they get good initial margins, safe initial margins to start with. Now, I know quite a bit about this, for the bulk of my experience in trading commodities was gained when I was the chief executive of the Mocatta Group, which was for 300 years the largest precious metals dealer in the world. And in that capacity, and as a member of the COMEX board, I witnessed firsthand the Hunt brothers' attempt to corner the physical silver market. They moved the price up by buying physical supplies, and as they bought more and more, banks and brokers granted them more and more credit on their physical holdings. And everybody started to worry that the silver bubble would burst, the Hunts would fail, and they would take the banks and brokers down. The Treasury Department, the Federal Reserve, asked the then chairman, James Stone, to intervene in the markets, but he said that the markets had the ability to regulate themselves, and the best thing to do was nothing at all. Perhaps he had heard of the ancient Greek who said, "Tais euandreas, tau uden poien en semphorais," which is to say, it takes great courage in a time of crisis to do nothing. Over the next few months, the price rose from $7 all the way to $50, and the American public took its rings off, sold its silverware, and even took out its silver fillings and sold them. Billions of dollars worth of new silver was refined and came on the market. The Hunts tried to buy it to prevent a price drop they thought would bankrupt them, but the little guy had more silver than they had money, and the corner failed. I'm going to comment more on metals in my written submission, but I wanted to mention the importance in thinking about position limits of disaggregating the positions of firms like ourselves who constantly tell our customers and the world at large just what mix of commodities is going to best lower the risks of stock and bond portfolios. We buy that mix for a customer only when that customer instructs us to do so and deposits with us all of the money that all those commodities would ultimately cost. His investment is thus fully funded, not partially margined, but fully margined with fully funded money. We don't trade for ourselves. We don't use leverage. We don't hold positions in spot months. We don't do it for our customers. And without all that, it's impossible to conceive of excessive speculation or of squeezes. That's why we think of ourselves as passive mechanics of our customers' wishes, and we think it's irrational and anti-competitive to aggregate our dozens of customers' fully funded positions as if they were our positions. And I was happy to see that this passive mechanic concept was taken up by Chairman Gensler at the recent energy hearings when he said that he didn't, quote, see a Goldman Sachs or J.P. Morgan swap desk as a passive mechanic. It's a highly sophisticated risk business, not a passive mechanic. Still, those enterprises can take as large a position as they want to hedge their exposures, and it's astonishing to us that a firm as small as we are may be forced off the safety of the futures markets and onto over-the-counter markets while our big competitors stay on. Here, too, it was Solon the Athenian who said, laws are like cobwebs. If any smaller creature falls into them, they hold it fast, while something weightier can break through the web and run off. To sum up, I would make 4 recommendations to the Commission. Number 1, position limits on metal futures can force such business into alternative channels such as over-the-counter, overseas markets, or, most important, into physical storage, because our kinds of customers have all the money they need to fully buy the metals and will do so. Secondly, the CFTC should continue to collect trade data so it has a complete picture not only of who is implementing trades, but who is benefiting from them. Third, once you identify that an entity is merely the implementor and not the beneficiary of a fully funded, transparent, on-exchange strategy, that entity's activities should be attributed to the ultimate beneficiary. Finally, don't tell yourselves that it's hard to identify the end users. It is administratively trivial to do so. You do most of it already via the large trader reports, and these would only need to be modified slightly to collect the data necessary to identify all those who control large and possibly dangerous positions. And I thank you for allowing me to offer my remarks on this important subject, and I commend the Commission for its efforts.
I thank you, Dr. Jarecki. It's a great honor to be quoted along with the Greeks and the others. So I don't know. Mr. Lothian.
Thank you. I'm the president and CEO of John J. Lothian & Company, a market-focused new media firm and commodity trading advisor. I am also a futures broker and president of the electronic trading division of the Price Futures Group, Incorporated, a Chicago-based introducing broker. I am here representing my own views. Thank you for inviting me. I want to talk about gold. Gold is the most international of commodities. No one nation has a compelling right to monopolize or dominate the price discovery process. More and more futures exchanges around the world are introducing precious metals trading, catering to their local market participants and impacting the global price discovery chain. Gold has little industrial value. Rather, its value is based largely on a system of belief of its value as a store of wealth and as a replacement for paper money. No longer do nations back their currency in gold. However, history is replete with examples where gold has served as a risk management tool for times when nations' ability to repay its debt has been in doubt. In times of war, when the debt of a nation could be worthless depending on the outcome of the war, people have flocked to gold to hedge this default risk. Consider gold historically as the ultimate credit default swap. I believe gold emerged from the commodity bull markets of recent years in the financial crisis of 2008 as the commodity to own because there was no natural political constituency calling for lower gold prices. Gold became the commodity of choice in which to invest, not only because of its unique political dynamics, but also because of the dramatic rise in public debt used to offset the impact of the financial crisis of 2008. Rising concerns about government's ability to repay the public debt through taxation renewed gold's value as a global CDS. The rush to invest in gold, gold derivatives like futures or securities like ETFs only fueled more demand as prices took off and breached historic levels. Also, low interest rates reduced the costs associated with holding physical gold and other metals, contributing to higher prices. The rise in political populism in the U.S. also plays a role in gold in our society, in individual and hedge fund portfolios, and brings to the surface historical pressures between creditors and debtors. There are those who openly espouse the view that gold and silver prices should be dramatically higher, that gold and silver prices are manipulated by central bankers and others to somehow keep inflationary expectations low. This narrow view of the nature of inflationary expectations is intellectually dishonest. Back in the late 1970s, when gold and silver had historic price moves amid higher levels of inflation, we did not have as many risk management tools to hedge inflation risk as we do today. Back in the 1970s, some traders and investors used things like soybeans, pork bellies, and gold and silver as a proxy to hedge against inflation. Bond futures were still in their infancy, and Eurodollar futures had yet to be invented. Today, we have liquid futures markets around the world for investors, governments, corporations, individuals to hedge their specific inflation risks. Those who believe gold and silver markets are manipulated to keep prices low are nothing more than politically opportunistic rent seekers in my book. They are parasites on the body politic, profiting from selling fear and seeking political change that will benefit their worldview and related market position. By selling views which undermine the trust in the listed metals futures markets, metal ETF securities, and even physical gold holdings of the U.S. government, these charlatans foster a view that distorts the metals market and impacts efficiency. Healthy skepticism is right and proper. Dogmatic mistrust is merely pseudo-skeptical behavior which cherry-picks evidence to, quote-unquote, support pre-existing beliefs. In precious metals markets like gold, the category of financial hedger should be interpreted very broadly. While there are bona fide hedgers who mine and produce gold or consume it for electronics or jewelry, this activity dwarfs the trade in those using gold positions or holdings to hedge against political or financial uncertainty. Even the metals holdings of the central banks themselves could be considered a financial and political hedge. For those who see gold as a substitution for holding other assets, including U.S. dollars, any action which restricts their ability to move into and out of physical metals, futures, or ETFs will be viewed negatively. These actions will not produce the intended results or intended effects. Position limits on financial hedgers in the U.S. will merely move global interest in the markets to other markets outside the U.S. Position limits on gold should be liberally interpreted and exclude financial hedgers. However, there should be greater transparency for concentrated holdings of metals, whether public funds or private investments. Accountability reporting should be expanded as positions grow larger. Think of harmonization between securities and futures. Lastly, position limits have their place in our markets, particularly in the futures and cash convergence process. However, I ask the Commission to act carefully in regard to proposing speculative position limits in metals before Congress acts on the issue of OTC trading in general. I believe acting hastily could put futures markets at a competitive disadvantage to the OTC markets and non-U.S. futures markets. Thank you.
Thank you very much. Mr. Murphy.
I'm going to have to make like the road runner here, so bear with me as I read this. Dear Chairman Gensler, Commissioners, the Gold Antitrust Action Committee was formed in January 1999 to expose and oppose the manipulation and suppression of the price of gold. What we have learned over the past 11 years is of great importance in regard to this hearing on position limits. Our efforts to expose manipulation in the gold market parallel those of Harry Markopolos to expose the Madoff Ponzi scheme to the SEC. Initially, we thought the manipulation of the gold market was undertaken as a coordinated profit scheme by certain bullion banks like J.P. Morgan, Chase Bank, and Goldman Sachs, and it violated federal and state antitrust laws. But we soon discerned the bullion banks were working closely with the U.S. Treasury Department and Federal Reserve in a gold cartel, part of a broad scheme of manipulation of the currency, precious metals, and bond markets. As an executive at Goldman Sachs in London, Robert Rubin developed an idea to borrow gold from central banks at minimal interest rates, around 1%. Sell the bullion for cash, and use the cash to fund Goldman Sachs' operation. Rubin was confident central banks would control the gold price with ever more leasing or outright sales of their gold reserves, and that consequently that borrowed gold could be bought back without difficulty. This was the beginning of the gold carry trade. When Rubin became U.S. Secretary, he made it government policy to surreptitiously operate an identical gold carry trade, but on a much larger scale. This became the principal mechanism of what was called the strong dollar policy. Subsequent Treasury secretaries have repeated a commitment to a strong dollar, suggesting they were continuing to feed official gold into the market more or less clandestinely to support the dollar and suppress interest rates and precious metals prices. Lawrence Summers, who followed Rubin as Treasury Secretary, was an expert in gold's influence on financial markets. Previously, as a professor at Harvard University, Summers co-authored an academic study titled Gibson's Paradox and the Gold Standards, which concluded that in a free market, gold prices move inversely to real interest rates. And conversely, if gold prices are fixed, then interest rates can be maintained at lower levels than would be the case in a free market. Fed Chairman Alan Greenspan understood Summers' research when he remarked at a 1993 meeting at the Fed Open Market Committee, quote, "I was raising the question on the side with Governor Mullins of what would happen if the Treasury sold a little gold in the market. That's an interesting question here because if the gold price broke in that context, the thermometer would not just be a measuring tool. It would basically affect the underlying psychology. President Obama has called for greater transparency in both the federal government and financial markets. In pursuit of such transparency, God has made Freedom of Information Act requests to the Fed and Treasury Department for a candid accounting of their involvement in the gold market. In reply to God's lawyers dated September 17, 2009, Fed Governor Kevin M. Warsh acknowledged that the Fed has gold swap agreements with foreign banks, but insisted that such documents remain secret. As a result, last December, God has sued the Federal Reserve and U.S. District Court seeking access to the Fed's withheld record of gold swaps. Understanding the manipulation of the prices of gold is profoundly important to all markets and the American public. On January 31, 2008, God had placed a $264,000 ad in the Wall Street Journal. God's ad warned, this manipulation has been a primary cause of the catastrophic excesses in the markets that now threaten the whole world. What God had warned against has come to pass. God has long implicated the COMEX as being a mechanism by which gold and silver price suppression is implemented. The smoking gun is the excessive concentration of bullion bank positions. This concentration enables market manipulation, just as market manipulation was a justification offered by the CFTC in 1980 when it acted against the Hunt brothers for manipulating the silver market. The weekly Commitment of Trader report documents the total net short position of commercial traders in the commodities markets. The monthly bank participation reports disclose the holdings of U.S. banks at various markets. In a letter to GATA dated February 19, 2010, Laura Garda, a CFTC legal assistant, wrote, quote, "The Commission determined where the number of banks in each reporting category is particularly small, fewer than 4 banks, there exists the potential to extrapolate both the identity of individual banks and the bank's position. As a result, as of December 2009, the CFTC no longer discloses the number of banks when it is less than 4. The CFTC has been investigating possible manipulation of the silver market for more than a year, so this report change is disturbing. The CFTC's own reports of November 2009 show that just 2 banks held 43% of the commercial net short position in gold and 68% of the commercial net short position in silver. In gold, these 2 banks were short 123,000 contracts, but long only 523 contracts. And in silver, they were short 41,000 contracts and long only 1,400 contracts. How improbable is that these 2 banks attract most of the investors who want to sell short? It has been possible to extrapolate the 2 banks that hold these large manipulative short positions in the COMEX are JP Morgan Chase and HSBC because of their huge positions in the OTC derivatives market, whose regulator, the U.S. Office of the Control of the Currency, does not provide anonymity when it publishes market data. In the first quarter 2009 OCC derivatives report, JP Morgan Chase and HSBC held more than 95% of the gold and precious metal derivatives of all U.S. banks with a combined notional value of $120 billion. This concentration dwarfs the concentration in the gold and silver futures market and shows great concern about the position of an issue. God has evidence there are huge physical short positions in the gold market that cannot be covered. Growing stress caused by burgeoning physical demand is threatening to lead to a price explosion, which restore to the markets the balance that regulations failed to maintain. In our view, the COMEX paper market will become dysfunctional.
You can just try to finish up.
We're finishing up. With force majeure having to be declared as the concentrated shorts are unable to deliver on their obligations. We urge the CFTC to report fully and candidly on these markets and take appropriate action. Thank you.
Thank you. I want to thank all of our panelists and if I'll just start with a question that I sort of asked the earlier panel too, but I don't know whether Mr. Norrish or anybody could have from their research. Just one of the issues, it's maybe a little bit more in the silver market, but in these other precious metals markets, is the concentration of these markets is more than the concentration, let's say, in the energy markets that we explored last year. And just to help us understand that concentration and how that affects the fair and orderly markets that because I agree with an earlier panelist that this commission is not a commission to set prices. It's not a price agency in any way. It's our main mission is to make sure that these price discovery markets are free of fraud and manipulation and that they're open and fair. But I'm curious what you think about the large concentrations and how they affect that price discovery marketplace. So I'm just starting with Mr. Norrish, but others can comment.
I mean, I think you know, as the remarks I was making in my introductory comments, I think were relevant to this. It's very important, I think, that there is the ability within all commodities markets and within metals markets as well, for financial participants to be able to be flexible in their approach and take large positions when they need to. Because the very nature of commodity market risk does tend to be quite lumpy. As I said, you've got large physical positions
Yes, Mike,
to be managed.
not to repeat what you've already said, my question is, though, when you get highly concentrated positions, whether the price discovery function is aided or whether, in fact, it might, you might get sort of a tipping point where there's a balancing that you get sort of maybe even less liquidity because there's this, I think Mr. Epstein used the term, I'm not sure, was it a big gorilla or something, but there was some term. But, that you have that in this situation. You want to hit your...
My experience is much more of the industrial metals markets. And I
so
think
maybe other panelists, I mean, I saw Dr. Jarecki was... No, Mr. Lothian?
The natural being of things is for consolidation. We see that in the brokerage firms, we see that in the banks, we see that in the exchanges. And so there is a natural progression towards that. And it does approach a tipping point where it becomes an issue. And that's your challenge to be courageous or not, depending on how you want to do something. That being said, it's present in all of our society. It's not any different there. I think that greater transparency in large concentrated positions can help offset some of that. We have lost a degree of transparency in the metals markets as things have moved from open outcry in electronic trading, who the participants are and what they're doing. So it's harder to track. And so in my comment about harmonization, for example, if I take a 5% interest in a company, I have to disclose that. Okay, so if we're getting into higher levels of participation, perhaps the CFTC rules should be changed and those things should be disclosed.
Let me just, because I see my light flashing, if I could ask maybe Dr. Jarecki, because you ran such a large precious metals company for, and I apologize, I didn't mean that you were there in 1671. I confused it with some of your ancestors maybe. But you were maybe here when the gentleman from Hong Kong, HSBC, said that at least in their experience, their large short on the futures markets was against some cash positions in London that are in vaults and so forth. Could you help us just understand? I'm still a little confused as to what the business model. Why would a large merchant hold so much physical inventory against a short that seems kind of constant? I mean, it's not like it's changing, so I'm curious.
Well, I think there are a number of different businesses involved, and the gentleman from Hong Kong, Shanghai, gave a good summary of some of those. Let me give you one or two of them. There's a great deal of lending of metal that goes on from merchants to jewelry fabricators and to silver film producers, for example. And so they buy the metal, sell it forward, and lend the metal out to people who don't want to take the risk of metal because they want to fabricate jewelry, and then shortly before they are going to sell it, they buy in their hedge and sell the jewelry. So that requires physical stocks. The same, to some extent, is true of what is called cash and carry. There's a question raised why this happened, for example, in the copper market, that there were large stocks of copper and yet unusual prices. Well, there are people who buy copper and sell forward copper and other metals forward because the carry is sufficiently high, 3, 4, 5%. They can get to, and those of you who are familiar with the finance markets know that it's very hard to get even 1%. In other words, you're able to have a fully secured, essentially collateralized loan, which you're getting 3% on. These are important differences for people. Equally, they will buy metal in one facility and sell it in another by an arbitrage differential. And as Mr. Epstein pointed out, that there came a moment where, as a result of sales or as a result of market movements, one market went lower than the other market. And sure enough, that's exactly what has happened over centuries, that people have moved precious metals particularly from a market where it was underpriced to another market where it was overpriced. So there are any number of events that happen in the metals markets and perhaps in other markets, but I'm most familiar with the metal markets.
I thank you, and Commissioner Dunn.
Thank you, Mr. Chairman, and this is indeed a great panel. Some of the panelists have repeated here. Dr. Jarecki, I appreciate now the tutorage in Greek. After getting the Latin, I think after hearing you the last time, I went back and polished up my Latin from being an altar boy, and I was still waiting for some of the regulators to come out and say mea culpa, mea maxima culpa, because there has been the fault of the regulators in the meltdown that we've had, and it's time that we do something about it. So I appreciate that.
Mr. Murphy, I know you had a distinguished career in football, and I think if you give this up, you can become an auctioneer. That was a great, great speed reading there of getting through that. And my good friend John Lothian, who claims the last time I pronounced his last name with an M on the end, wrote in his blog, how would Commissioner Dunn like it if I spelled his last name with an M? So I have to be extremely careful here as I stumble through the questions that I'm asking. But I'd like to get each of the panels to respond to one of my major concerns, and that is if, in fact, we put position limits in these markets, does it not, in effect, do the same thing that happened in the Modernization Act, where Congress told us don't look at over-the-counter trade and allow those things go to an OPEC marketplace and diminishes our ability to understand what is actually happening? And I'd like all of you, in whatever order you'd like to respond to that.
Keep it.
I am completely concerned about that view. So we have this notion in America, because we only look at our futures markets, many of us, and we think, oh, well, that's a pretty big market. But in truth, as we've heard today, the London Bullion Market Association is in many ways already larger in the gold market than COMEX is, the CME is. Certainly the copper market is substantially larger. The COMEX copper market, let's put it in English, and though I've been a director of that, I'm not trying to offend them, but it is a market that is struggling. The CME market is a struggling market, and to do one more, it's one more nail in the potential coffin. There are a lot of people that wonder, will there be an American copper futures market? But it is easy for us to chase markets overseas. Again, I want to speak to, since the chairman took me to my 17th century roots, the gold and silver markets moved from Oporto, Spain to Antwerp, from Antwerp to Amsterdam, from Amsterdam to London, and they did so largely because of regulations. First, from the Inquisition, most of the gold dealers moved up north, and then ultimately moved to London for different reasons relating to the diamond trade. But markets do move, and they stay where they go until there's a good reason to go somewhere else. We're giving markets a good reason to move somewhere else. The Paris wheat market has, since these discussions have happened, has increased manyfold. There is currently, I think it's the S&P is putting together an index made up only of offshore markets. And it says we're doing this in case overregulation happens in the United States. It is easy for us to chase markets overseas, and we will. I'm somebody who's heard for the last 30 years every little thing that we do. Oh, we're going to chase the markets to Europe. They said that about taxes, or they said it, you know, one thing or another. I never paid attention to those things. This thing, I think, is real, and it's happening as we speak. There are many markets that are already larger than the American markets, and certainly the Chinese markets, many of which are bigger in many areas than ours today, and we ought to look at all of those together. Thank you.
Callahan?
If I may, Commissioner Dunn. My boss, Duncan Niederauer, had the unenviable job of following in Chairman Gensler's footsteps 2 weeks ago at the Boca Raton conference after a great speech where he used Mrs. O'Leary's cow as a metaphor for what happened during the financial crisis. So we have been strongly supportive of the general direction that you have proposed in terms of derivatives regulation. But there certainly are a number of push-me, pull-yous going on. Certain of the proposed pieces of derivatives reform are pulling markets out of the opaque OTC markets and into the transparent, centrally cleared exchange environment. I think we would all support that as a goal in the wake of the financial crisis. certain elements, and I'd probably put federally mandated position limits, at least if they're applied perhaps incautiously, would be a strong force in the other direction that would keep transactions away from central clearing, away from exchanges, and maintain the status quo, which I think would be unacceptable to a lot of people in this room. So at NYSC Euronext, Commissioner Dunn, we would share your concerns.
And if I could ask, just because there are times that, you know, management is too, is if you want to comment, if it's different, yes, but if it's sort of in the same vein, we might move on to Commissioner Summers. No, Dr. Jarecki's already commented.
I would say that I think there is a danger of that, and I think it would be a shame. I mean, you mentioned when you introduced me that there are a lot of my charts with CFTC data, and I think what you have in the US is you do have a lot of transparency, you do have a lot of data, which enables analysts like me to make sense of what's going on in the markets. And you know, the global metals markets are concentrated overseas. The Shanghai futures market now accounts for 40% of global metals trading. There's far less information available on what's happening on that market. But I think the danger is if there are limits placed on US futures markets, that's what will happen. And then from an analyst's point of view, the great data that you're providing becomes much less useful to us.
I would just add one thing, and that is that in the last several years we've been banging away on speculators here in the United States and their role in the markets. And at the same time, around the world, we see other futures markets maturing and being dominated by speculators, many of them small speculators, particularly in Asian countries. So I think that there is a risk if you limit the amount of speculation here, that it will grow other places, because it is already.
I think the helpful, go ahead. I think position limits would be helpful, but the key issue will be the concentration of the big shorts, and then to get into the exemption issue, because there's no point in having position limits if the big boys can do whatever they want, and there's no way to really know what they're doing.
Commissioner Dunn, thank you. Commissioner Summers.
Thank you, Mr. Chairman. I don't have any questions, but just to say that I appreciated that last question by Commissioner Dunn, and I think it's important for us to weigh those kind of unintended consequences as we weigh the complexities of these issues. So thank you to this panel.
Thank you, Commissioner Summers. Commissioner Chilton.
Mr. Callahan, you have position limits. You use position limits, correct?
Yes, sir.
Okay. Now, that's in the U.S. you have position limits. You don't do it on NYSC Liffe in London, right?
We don't trade precious metals on.
But on any other contracts in London, you don't have position limits, right?
I'd be happy to send you. We do have position limits on certain of our contracts in London. We'd be happy to supply.
Okay, so you have position limits in London. So this talk about, well, we're going to send markets overseas without even knowing what level we would set the position limits at. For example, say you set the level at 5 times the accountability level. Our proposal on energy, we said, would only impact, given what had happened historically, several traders. The numbers were between 10 and I think 27. So it's not a huge number of traders. So the concept of a position limit, for all these fears that we're going to lose markets, that it's going to go OTC, it's going to go overseas, we're going to lose liquidity, our kids are going to get kidnapped. I mean, it seems to me that it's really the level that we would set it at. If you screw it down so much that people didn't have an avenue, but as a general concept, if the levels were so high, and that they might be ineffectual, but just the idea of a position limit, I don't think should be so ugly scary. The concept to me seems like a solid concept. So I like having the possibility of a system. Now, Mr. Callahan, you come up with these position limits, as you just said, overseas and in the US. And how do you set those? What, for example, is too much concentration in a market? What's too much concentration in a market?
Well, I'm the CEO of our U.S. exchange, and So I'll speak specifically to that. And as we look at the position limits that exist in our U.S. precious metals contracts right now, we are a very small percentage, as we are a young startup exchange right now, roughly 5%, give or take, of the U.S. precious metals market. So we have set those limits. They're actually the same ones we inherited when we acquired this platform from the CBOT. We examined them when we acquired the platform and determined that relative to the size of our market, and more importantly, relative to the size of the U.S. market, that they were adequate.
I mean, you even make a point, I think, in your testimony that perhaps smaller or startup exchanges should be exempt from these position limits for competition. But you have them; they already exist. And,
So,
do you think it's working out well for you?
It's working out well, but I'd make the important distinction between a federally mandated position limit and one that is administered by the exchange.
Why? Because you can, I mean, Mr. LaSala said, well, we're closer to the markets and everything. I mean, isn't that our job to be close to the markets too?
I would say that we're in a time of unprecedented change, and hopefully we're going to be seeing multiple OTC products migrate towards exchanges. If that's the case, what we now consider the exchange-traded market could increase substantially. I think the exchange is in a very good position to monitor and adjust those as needed. My concern would be that if they were federally mandated, they would be much less flexible. And you could see the situation where, again, you're pushing transactions away from the regulated transparent markets or into one of the 14-odd global exchanges that currently trade precious metals. As Mr. Lothian correctly said, it is the ultimate global commodity.
I'm pleased that you have them. I commend you for them. I agree with you, these are unprecedented times. And specifically because of these unprecedented times, I think what we've seen over the last 10 or 11 years is that government actually needs to step up and be part of this. And that's to say nothing negative about you. Again, I commend you and Duncan Niederauer for doing a good job. But it seems to me we've got a public responsibility to protect consumers. We have a motive here that doesn't involve the word profit. It involves consumers and traders and people that are parts of these markets. So I think it's our job to get involved in this. I see my time's about to expire, but I would like Mr. Norrish to, you're not going to be able to respond right now, but think about it. The question that I asked, I don't know if you heard it from HSBC, Mr. Charles, about trading for your own book under exemptions, and could you separate that trading? So I'll try to ask you when we get around next time. So, thank you.
Thank you, Commissioner Chilton. Commissioner Malia.
As the newest member, I generally find most of my questions have already been asked. But also as a newest member, I'm trying to understand the relationship we've had with agriculture products that have had position limits for a very long time, and they experienced some very record price increases in 2007, 2008. And I'd like to get everybody's views on how metals position limits, in light of the ag demonstration, what would happen, do you think, if we put position limits? Would we be spared price increases? What would happen?
Commissioner, as part of my written testimony, we did submit a chart on the back that looked at 1 year of price increases of commodities that had federally mandated position limits versus those that doesn't. It was actually data that came from the CFTC. I think the conclusion one would draw from that CFTC data is that it is inconclusive that federally mandated position limits are an effective tool for moderating excessive price movement.
Yeah, I think the result of that would probably be, you know, we've seen volatility in agricultural markets, so I think it's clear that position limits don't necessarily act to take that volatility out. And my feeling is that, you know, the most efficient markets are the bigger ones. The US agricultural markets are relatively small in a global scale, but the most efficient markets are the bigger ones. The industrial metals markets are very big and they are liquid. And if you put position limits in that start to remove that liquidity, you're not going to smooth out prices. You're probably going to end up making them more volatile in the short term. And my concern also is that if prices are artificially pushed down, even if it's only for a short period of time, that has longer-term implications for the supply side of the business as well. We need to see a lot of growth in supply on the industrial metals side, and my concern would always be that if we take liquidity and risk management ability out of the financial markets, then we're not going to get the growth in the physical markets that we really need.
Dr. Jarecki?
The question is whether what the impact of position limits would be both on prices and on volatility. I think that all the evidence that exists is that the high prices that have been seen in the last years existed in all markets, not only in futures markets, but equally in steel and iron and rhodium. A lot of things just ran up, and they ran up to some extent together with or separate from. What had happened really was that the government has printed so much money, that money is going into something, and we see price, it must go into commodities or real estate or one thing or another. And that's what brings prices up. And I don't think whether they're on an exchange, not on an exchange, is that relevant, except that an exchange moderates it because there are more people involved. Certainly, being on an exchange lowers volatility. That's been seen everywhere. The high drama of 2 or 3 decades ago, about 4 decades ago, about onions. The onion market has been a disaster since it was taken off the futures markets. And I understand that there's a congressional mandate on the topic, but the truth of the matter is that volatility is diminished when things are placed on exchanges because there's simply so many people looking at it and saying, that price is too high, this price is too low, and taking actions on it. So my view is it'll increase volatility and it won't affect prices measurably or predictably.
Anytime you add friction to markets, you're retarding the price signal, and the price signal is very important for producers, for consumers, and the like. And when you're talking about the types of challenges that we're facing that have been outlined here in terms of the amount of investment that we need, okay, the higher prices are signaling to us we need more production, we need more selling. I talked about this before. And so anything that you're doing to retard that and say, oh, the prices should be lower, we need to restrict this, not let it get to its free levels, or it's gonna swing over here to the over-counter because it can't find its natural equilibrium in the futures market. All of those things hurt that price signal. And futures markets are ultimately about 2 things: price discovery and risk transfer. Okay, but the first and foremost is the price discovery. So you want to look at what it's going to do relative to that equilibrium.
Might want to give Mr. Murphy the last.
I'll get the hang of this yet. Anything that will limit the ability of the big bullion banks to bully the market will be a big plus and will lead to greater price discovery.
Thank you, Commissioner O'Malley. I don't know if there are other questions I just wanted to say a few words on mine. All right, great. So we'll do another round, even better. And I suspect there'll be a blog on this when I differ a little bit with Mr. Lothian. But you mentioned that friction retards, anything that's friction retards the price signals in the markets. But I think that we live in a nation that we benefit from regulation in the securities markets. Certainly when any issuer has to file a 10K or a 10Q, somebody could say there's a cost in that. I think that we benefit in a nation of laws. We have traffic lights. You could say a green and a yellow and a red light is friction. It does slow down traffic, thank God. So
running into another car is also friction.
What's that?
Running into another car is also friction, so I agree with you.
Absolutely. So I think that we do benefit by having a regulated market economy, and then people like us getting these jobs, and we have to sort through and have hearings like this to see where we come out. To me, it's not about prices. To I appreciate Commissioner Amalia's question, and I think it was a very good question. To me, it's a question of these position limit authority that we were vested with in the 1930s is to promote these fair and orderly markets. And my central question in this hearing has been about concentration, because that's what at least I'm interested in, is to do the silver markets and gold markets with the higher concentration that they have, and in sometimes very high concentration. Are those the best functioning of the markets? Do they bring that price discovery function together? Onions, by the way, I think was in the 1950s, and I think it was a congressman from Michigan named Gerald Ford that was involved in it. What's that? I don't. And then Commissioner Amalia went there. I want to associate myself, because I don't have a question, I'm just going to associate myself with Dr. Jarecki's comments earlier and maybe appropriate them in later hearings. I think that we have found in the futures markets a rational way to deal with leverage. I think that was the words that you used, that the clearing mechanism invented in the late 19th century has survived through 2 world wars and Great Depressions and many bank failures. It's not perfect, but I think it works well, and that's why I'm so much believe we have to bring it to the over-the-counter derivatives marketplace as well. And I thank Mr. Callahan's comments that I think if we can bring the transparency as well, that's going to be big. But Commissioner Dunn.
Thank you, Mr. Chairman. I said during the position limit meeting on energy that for the large meltdown that I thought 3 things ought to happen. There ought to be more transparency in the marketplace, that we need some type of re-implementation of the Glass-Steagall Act, and that we needed to implement antitrust. And since then, the administration has come out with the Faulkner Rule, which I think is a good direction to begin looking at. Mr. Norrish, I've just finished Secretary Paulson's book on the brink, and everybody takes away